And cut.
Boom. Cool. We're just hitting it live, having some fun, talking about real estate, getting warmed up.
This is the
cut this.
The
just
first
cut this.
one, yeah.
Cut this right here. All right. So here's the first topic. Headline: Interested in interest rates. The wind behind the sail with multifamily real estate is interest rates. Where interest rates are really determines how pricing moves. When interest rates go higher, prices tend to go lower. Vice versa. When interest rates are lower, prices go higher. It's pretty much accessibility to financing really drives the acquisition market. In today's market, we are in a rising interest rate environment. Let's speak on a bit of data here.
I just pulled up the Fed's fund rate, just going back on historical from the last really just like a year and a half. Early 2022, we were at 25 basis points, and then it's hiked up to, looks like 5.75. So we're talking over 5% over a year and a half, somewhere around there.
So that's a huge move. So what you said is 25 basis points, which is 0.25%, under 1%. So we went from under 1% toward just after 2022, where today we're looking at, would you say 5.75?
Somewhere around there, yeah. It's hard to zoom in.
So we're at 5.75%.
Yeah.
Think about that real estate market where you're able to buy a property for X, Y, and Z, and you're able to apply debt to it, and your monthly payments on your mortgage are 3.5% to 4% interest rates, where today you're looking at like 7% interest rates. That is a massive, massive difference. Something's got to give. Well, the big problem that we see is that sellers are not ready to accept this reality of a higher interest rate environment where they have to actually cut back on the pricing of their properties. We're seeing it a lot. We've been affected by that. In this rising interest rate environment, transactions have, not saying come to a screeching halt, but they have dramatically decreased.
We've kind of seen two types of offerings. We've seen this assignable, assumable debt. We just pretty much walked pretty deep into a deal and ended up losing the bid. A different story for a different day. But assumable debt is pretty attractive, which means the cap rates can be kind of compressed for deals like that. People are pretty much, a guy like me and Travis are more than happy to take on a property if it's got stabilized debt at prices from a couple years ago. Like that deal was 3 and change or something was the interest rate?
The percentage, we were 3.94%.
Pretty cheap when you consider that, like, new debt you're shopping around today is 5-6% depending on your asset class. Bridge debt 7-8%. So pretty cheap debt there. The other flip side would be what I just mentioned there, which is the bridge debt, or even just Freddie Fannie debt, agency debt, which at today's rates are 6s, 7s, 8s, 9s if you're in bridge. And that, when you consider the cap rates of 5-6%, even 4 if you're in a really tight market, it's like the spreads on those cap rates are so far negative, it's crazy. So everybody's trying to buy on a pro forma. The sellers think they got a winner, and the buyers are just trying to come up with a deal that returns even just a decent return to their investors, not even a home run 2x multiple like we saw a couple of years ago. You're looking at 1.7, 1.8x for a lot of people nowadays. So it's definitely a different game. Interest rates are making people be a lot more choosy on the buyer side, and the sellers are not really waiting for those people to be choosy. So it's interesting.
Yeah, definitely a crazy market. And something else to weave into that, everything else has become more expensive. It is hard to find good labor. So costs of material and labor have gone up. Costs of insurance have gone up like crazy. Effectively, everything else has gotten more expensive, including financing. And sellers, if they're not market sellers, if they don't have to sell, people are waiting because the prices are not where they want it to be. Will the market change in a year from now, where interest rates are going to actually check back down? I don't know. Nobody knows. If we knew that, we would be billionaires right now because we would make the appropriate bet. We would go long bonds or short bonds, and we'd be billionaires. Nobody has that answer. But what we do know is that everything is getting more expensive, debt is getting more expensive, and these rising interest rates need to eventually lead to deals becoming a little more favorable. So, interested in interest rates? You bet. Oh, you bet we're interested in interest rates.
Finally hit the tagline.